Hi everyone, my name is Aman Raina and I'm an investment coach here at Sage Investors, and I'm here to do a quick mind map video of my evaluation of Consumer Staples ETFs. A while ago, I made a decision that I wanted to have some exposure in my portfolios to some consumer staples type companies. Reason being, I think I was looking at the performance right now of the overall market, and it seems like consumer staples sector has been kind of lagging the overall market. So I thought maybe there's another opportunity to build a position in it. Now the thing is, I usually go and analyze individual stocks, but right now I'm just so busy right now with a whole bunch of different projects going on that I just don't have time to do a really meaningful deep dive. So I said to myself, you know what, I'm just going to do kind of just buy a basket of consumer staple type of ETFs of companies within an ETF and get my exposure that way. So what I did here was I did a scour, I did a search, and identified 5 different kinds of ETFs that are out in the marketplace. And for each one of these ETFs, I went through a process and a framework that I usually incorporate when I'm analyzing ETFs to try to figure out which one is the one that I kind of want to get into. So what we have here, as you can see, is I've kind of laid out 5 different ETFs that I'm going to walk through, and I'm going to analyze each one based on a set of criteria, and they include asset, whether the portfolio's has an actively managed or passively managed, the associated fees, liquidity, trade volume, the type of benchmark that it is mirroring or trying to track, the makeup of the portfolio. Is it highly concentrated in a couple of stocks, or is it kind of has a good, nice diversification on it? And then also looking at the tracking area, the ability of that ETF to mirror the returns of the index that it's trying to keep up with. So let's just jump in and take a look at some of these 5 ETFs that I came up with. So the first one that I came up with that I'm going to take a look at is the ticker symbol XLP, and this is the Spider. The Spider brand. This particular ETF is a passive ETF, as it tracks essentially the benchmark of the S&P Consumer Staples index. So it's a very passively managed portfolio. Its MER, its management expense ratio or fees, total 0.13%. So it's a very cheap, low-cost ETF, very passively oriented, tracking a common index. Liquidity, in terms of shares traded, it's a very liquid stock, a very liquid ETF, in that on an average basis, there's almost 16 million shares traded in the XLP. So it's a very, very liquid place. So you're going to get some good price discovery, and the pricing mechanisms around it are very consistent and solid. The portfolio makeup, when I looked into the portfolio of how it's constructed, almost 2/3 of the portfolio is concentrated in literally the top 10. If you look at the top 10 holdings, 2/3 of the value of that portfolio is in the top 10. So it's very highly concentrated in a really select basket, which is kind of makes sense when you're tracking a sector kind of ETF. There's not like 500 companies you're going to find in a sector ETF. It's going to be, 20 to 30, and a lot of it's going to be concentrated. So that's one element to it. So one thing that's cool about this ETF is that it's a very highly concentrated, but it has a very low cost to it. So that's kind of a unique feature, and it's a compelling feature that you want to take a look at. Finally, the last feature for the XLP is tracking error. Now, basically it's the variance between the portfolio return and the benchmark that it's tracking. And so the difference between those two variables, data points, is for the XLP is about 3.4%. So there's a bit of which is a little bit high, because ultimately you want to buy an ETF that's tracking the performance as close as possible to the index. You don't want to, because otherwise you're just leaving money on the table, and you can do a better job of doing it yourself. That's the whole point of buying ETFs, is try to get that instant or as close to the return of the market index that you're trying to track. So that's the XLP. So let's go to the next one, which is the VDC, which is the Vanguard product. And again, this is it's a passively managed portfolio, but it's got a bit of a wrinkle to it in that it's tracking a basic index. But the thing is, the index that the Vanguard is tracking, it's called I can't even remember the name, spliced index. It's basically it's not a third party. It's something. They essentially a self-index, and that's a lot of thing people don't understand with the Vanguards is that a lot of they used to be very the portfolios that the indexes that they used to track were very third party, but more and more a lot of their portfolios and ETFs are self-index, and that they have a bit of a control in terms of the benchmarking, and that's from an investment perspective, that's not a great thing to see because it can kind of give the ETF vendor the ability to, if performance wasn't that great, to alter the goalpost if you want and make the performance of the ETF look better than maybe it was. And so there's a little bit of manipulation that could be done with it. Vanguard's pretty straight up with stuff, but to me, it's a little bit of a flag for, when I see these type of self-index kind of ETFs that are out there. MER for this company, for the VDC, is 0.10, which is really competitive. It's cheaper than the XLP. On average, you get about 126,000 shares traded on a daily basis. If you look at the Brent, we just did the benchmarking. The portfolio has, if you look at their top 10, almost 65% of their assets are in the top 10 holdings. So it's a highly concentrated portfolio. What's interesting is the tracking area. The tracking area for the VDC came in at 0.31%. So it's it tracks very closely to the benchmark. So that's definitely something you want to see as an investor. So that's the Vanguard product. So now let's take a look at the KXI, which is ticker symbol KXI, which is an iShare product, and it's a little bit unique in the sense that it tracks the VDC and the XLP are more US based, but the KXI has a global. They has a basket of global consumer staple oriented companies. Passively managed, has an MER of 0.46, so you're paying a little bit extra for the global exposure there. On average, trades about 28,000 shares a day. It does track the S&P global consumer staples portfolio, so it is passively managed with a third-party index. When I looked at the makeup of the portfolio, almost 42% of the assets were concentrated in the top 10 holdings. So it's a little bit more diversified because, I guess, more global in nature, so there's more companies involved, so that makes sense. And then the tracking error came in at 0.26%. Again, really good, really close. You want as low as you can get as possible. So it's pretty good tracking error there. Next one on my list was the ticker symbol IYK, which is the iShares US Consumer Staples ETF. So this is more in line, closer with the VDC, and this is more closer to the VDC and the XLP. They are kind of almost one and the same there. Passively managed portfolio. Passively managed portfolio has an MER coming in at 0.43%. Again, it's probably more expensive than the XLP and the VDC, and it's more consistent with the KXI. There are 25,000 shares on daily average in terms of volume. It tracks the Dow Jones Consumer Goods Index, so it's tracking a third-party index. But 50% of the assets in there are invested in the top 10. So it's got a bit more of a broader distribution than compared to the XLP and the VDC. Tracking error for this is pretty high. It comes in at 6.25%. So it's a high tracking error associated with this one. And finally, the last ETF that I took a look at was the ticker symbol XST. Now this is the iShares. This is the Canadian ETF. So this is the Canadian one. So Canadian consumer staple companies. And there's only, compared to the other ones, there's 50 to 100 companies, or 34, 50. There's only like 11 companies that are in this index. So in this ETF, ticker passively managed portfolio, again, has an MER coming in at 0.61, so it's pretty high. Trading volume 2,700 shares a day. 2,700 shares a day. So it's a very low. Doesn't have a lot of liquidity, so you're going to see a lot more variance in prices in the spread. It tracks the S&P composite or capped Consumer Staples index on the Toronto Stock Exchange, and it says that the portfolio 70% of the portfolio is concentrated in 4 companies, which is very, very high. And when you got this type of concentration, then it's really, you might as well just buy those 4 individual stocks, and you're going to get at a much more lower price point than buying the ETF in a sense. And then finally, the tracking area for the XST comes in at 4.3, roughly about 4.39%. So it's also pretty high. So that's the tail of the tape. And so at the end of it, I put all these numbers together. And so the goal here is, okay, let's figure out which one. So which one is here, from my perspective, did I end up going with? So first thing I want to look at, they're all passively managed, so that's good. So I'm going to get a broad exposure to the index. There's not going to be a lot of flipping and churning in the portfolio in that sense. So they're all pretty good in that perspective. When you look at it from a cost perspective, obviously the XLP and the VDC look very, very favorable from my perspective. I thought the globals and the IYK and the XST a little bit too high for my liking. These are very, 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 very competitive costs and low costs, so there's more money going to stay in my pocket. Liquidity perspective, well, clearly the XLP, 16 million, like the other ones aren't even in the same area code as that from that perspective. And the VDC has a pretty good trading volume there. That's pretty reasonable. 28,000 and 25,000 from the KXI is okay, but it's obviously not as good as the VDC, and clearly not even near the XLP. As I said, all of the indexes, the benchmarks that these ETFs are tracking, are pretty third party. So there's a lot of potential manipulation. The Vanguard one has that independent one, third party, has their own kind of self-indexing kind of benchmark that they use. So that's a little bit different from that perspective. Portfolio-wise, if you look at the concentration of it, the global portfolio at only 42% concentration in terms of the top 10 top 10 holdings, is probably the more diversified of the bunch. The the Canadian one, just 4 companies, to me is that's just crazy. I don't think I would just buy those 4 companies if I just wanted that maximum, if I just wanted to mirror a portfolio. And then tracking area perspective, the VDC and the KXI come in pretty much, are very, very strong in terms of tracking error. The returns that they generate are very similar to the returns that the index is trying to market. So that's kind of the tail of the tape. So what did I do? So what that's great. We did all this analysis. So I got to pick something here. So to me, the Canadian one just didn't cut it for me. If I wanted to get that exposure, I would just take that one out. I liked the Spider one, also was looking appealing to me, but the only thing that kind of drew me off was the tracking error. That it's just, I was quite surprised to see that there was such a variance in terms of the tracking error. The IYK, the iShares one, again, that tracking error thing, I just didn't like that too. It was pretty high, also pretty high cost associated with it. So again, it comes down to, do I want a global exposure, or do I want am I fine with a sort of a US oriented type exposure? And at the end, I ultimately decided to go with the Vanguard product, primarily because very low cost. Obviously it doesn't have the 16 million shares or high volume that the XLP does, but 126, that's a pretty decent volume trade. I think you get some reasonable price discovery. And the tracking error is quite low. And even though the company is sort of self-indexed, as much as I'm not a big fan of it, I know Vanguard's pretty straight up company in the sense that they really are, they do take due diligence in terms of making sure that the returns that they generate are competitive and accurate. So I'm willing to give them the benefit of the doubt in terms of this aspect of the index, of the benchmarking side of it. And the fact of the matter is, it's also highly concentrated. It's, 2/3 of their assets, or holdings, are in, of the money in that fund is in their top 10. So, but the reality is, again, when you're buying a sector-oriented fund, you're going to get a higher concentration. And again, the fact of the matter is, it's highly liquid. These are liquid assets. They're not going to go, there shouldn't be serious variances in pricing for the ETF itself. So when I've put all these elements together, the winner that in my little analysis came out to be the Vanguard Consumer Staples ETF, ticker symbol VDC. If you're interested in any more of my mind map videos on individual stocks and ETFs, feel free to check out my website, sageinvestors.ca. Thanks again for watching in and listening in. Take it easy. Cheers. Bye.